In another special report, we talked about how Wall Street's love affair with Beijing is causing concerns. There, we explored how Wall Street pumps investors' money into the Chinese regime and why. Now, that love affair continues, but as China behaves more and more like an abusive boyfriend, Wall Street still chooses to stand by the country. In this special report, we look at how American investors are losing billions of dollars because of Beijing's recent attacks on several of its own industries, how big names on the street are still vouching for China, and whether China is still investment worthy at this point. But first, a quick recount of what's happening. As the Chinese regime continues stomping on its domestic companies, many of which receive Western investment.
Machine would do better.
It all started last year with Chinese billionaire Jack Ma and his financial tech giant Ant Group.
China putting the brakes on the world's biggest IPO. Ant Group's listing in both Shanghai and Hong Kong have been suspended.
The shares Ant Group had already distributed to American investors simply went up in smoke. Next, it was food delivery giant Meituan. Chinese authorities launched an investigation into the company. Their reasons?
What regulators are saying is that Meituan has been involved in, and this is the allegation at least, anti-competitive practices.
Then last month, a company Western investors were super excited about, Chinese ride-hailing app Didi.
Well, Didi's share sale is the biggest by a Chinese company since Alibaba IPO'd in 2014.
An IPO, or initial public offering, is where a company sells part of its ownership stake to investors in exchange for their investment. But just days after Didi's IPO, the Chinese regime ordered all of its smartphone apps to be removed from app stores and opened an investigation into the company. Soon after, Chinese state media outlets suddenly started lashing out against a video game owned by Chinese tech giant Tencent, calling it spiritual opium. And then comes the authorities' war against China's private tutoring industry, another fast-growing darling for Western investors.
U.S. shares of Tall Education and New Oriental Education each dropped more than 50%. Both provide tutoring and test prep services in China. It's just after news the Chinese regime is barring tutoring for profit in core school subjects. One trader says the pain of regulatory uncertainty has caused many to just give up on Chinese tech stocks.
This series of actions isn't just harming Chinese companies. Last month, a Wall Street Journal reported that investors lost hundreds of billions on China in July. And that money isn't from Chinese investors, it's cash from American investors.
They are killing us. I mean, they know that we own these stocks, and they're showing no mercy.
According to the Journal's report, investors like the pension fund Orange County Employees Retirement System in California are reconsidering whether they should cut down on China stocks in their portfolios. That's on top of financial service companies. In fact, a lot of American savings end up in Chinese companies through U.S. state and pension funds. According to U.S. government data, the state of California poured more than $8.4 billion into Chinese securities since 1992. That's followed by the Alaska Permanent Fund Corps with more than $2 billion, and the Teacher Retirement System Texas with more than $1.1 billion. Other U.S. states with major investments sunk into China include New York, New Jersey, Colorado, Wisconsin, Kentucky, and Ohio, among others. Up until 2019, Yu Meng served as the Chief Investment Officer for the California Public Employees Retirement System. Before coming to the U.S., Meng worked as the Deputy Chief Investment Officer for the Chinese regime's agency supervising China's trillions of dollars in foreign reserves. Setting aside the ethical concerns of giving money to companies that operate under a regime that's committing genocide, there are a number of economic risks involved with investing in China, as we've seen in cases we mentioned at the beginning of this report.
Beijing is willing to crack down on certain industries almost at what almost seems like at the drop of a dime. And so one day you're investing in a certain industry and you think it's a safe investment. The next thing you know, Beijing is saying, no longer, we're not letting that happen anymore. Beijing might come out with a new rule, a new regulation, and it could completely wipe out, I don't know, maybe a few $100 million worth of value on a company. And For investors, that means a lot.
A former banker in Asia and an expert on the Chinese financial system once told the New York Times, one of the basic rules of operating in China is everybody is a dog on a leash. Nobody has freedom. The party does not give anybody freedom. They merely give them a leash. Other than Beijing's unpredictability, another risk of investing in China has been gaining traction lately. The chair of the U.S. Securities and Exchange Commission, or SEC, even made an explainer video on the issue.
When American investors think we're investing in a Chinese company, it's much more likely that we're actually investing in a company in the Cayman Islands.
That's because the Chinese regime doesn't allow foreign ownership through investment in Chinese companies.
Companies establish contracts with shell companies in other countries. Those shell companies then raise the money on U.S. exchanges. So when you think you're investing in a Chinese company, you're more than likely actually investing in a shell company in the Caymans or another part of the world. Now, the Cayman Islands are beautiful. You can swim with the turtles, swim with the stingrays. It's really fun. But on the other hand, investing in a shell company in the Caymans is different than investing directly in a company in China.
They're called VIEs, or variable interest entities.
When you buy these Chinese stocks, you don't own anything. You own a fantasy football share of something, right? You own a variable interest entity in the Cayman Islands. If Alibaba were to liquidate, you don't have a claim on Alibaba's assets as a Westerner. You have a tracking stock. You know, fantasy football is you're investing in a team that's just a fake team, and however they play, you either win or you lose. That's exactly what you do when you buy a Chinese stock. It's insane that this much institutional capital is going into fantasy football shares of companies that don't submit themselves to audits. And yet, greed and avarice is what takes us there.
What's more, some have been questioning whether Chinese companies really perform better than their American counterparts. Chinese search engine Baidu, for example, had an operating margin of 13.39% in 2020. That's compared to 22.59% for Google. And for Yum Brands, whose subsidiaries include KFC and Taco Bell, the company's China side operating margin comes in at a little over 10%, compared to nearly 30% for its U.S. business.
I think there's actually a lot of economic problems that we don't see happening in China a lot of the times. And I think it's because of Beijing's power to sort of influence information that's being shared or the information that is being shared to sort of hide a lot of that financial risk.
Despite all that, some big names on Wall Street still vouch for Chinese stocks. Investor Ray Dalio says, quote, China's recent regulatory crackdown has been misinterpreted as being anti-capitalist by some Western investors, who will, as a consequence, continue to miss out on what's happening in the Asian country. And major investment management firm BlackRock recommends investors triple their exposure to China stocks. This after Chinese authorities called in banking heads late July for talks, an attempt to restore calm. Bloomberg reported that representatives from Goldman Sachs, JP Morgan, BlackRock, Fidelity, and UBS Group attended the meeting. But the communist regime's recent actions seem to have had the opposite effect, leading some to question whether Beijing has become tired of its decades-long trial of capitalism and market economy. This month, the regime's Central Committee for Financial and Economic Affairs outlined a series of edicts designed to ensure common prosperity within Chinese society. The agency is now encouraging high earners and businesses to give back to society. Some worry whether the regime is steering China back in the direction of the communist economy, the same structure the country followed from the 50s to the 80s. The regime isn't making things easier for Chinese companies to absorb domestic or foreign investments either, regardless of whether they come from inside or outside China. Last week, Chinese market regulators put a stop to more than 40 initial public offerings. That's after they launched a probe into an investment bank and a law firm. Across the Pacific Ocean, the U.S. SEC is setting new requirements for Chinese companies if they want to list in New York. Now, they'll need to offer more information. The change comes after the SEC last month asked for a pause on IPOs from Chinese companies because some of them weren't transparent about risks in the past, leading to huge investor losses. We are now seeing an unprecedented and unusual phenomenon. Both Beijing and Washington are tightening scrutiny against Chinese companies. It remains to be seen whether the two forces' efforts could result in a de facto financial decoupling of the world's two largest economies.